Ladies and gentlemen, good day, and welcome to the Escorts Limited Q2FY15 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravindra Jaipuria of Perfect Relations. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Escorts Limited Q2FY15 results conference call. Today we have with us Mr. Sridhar, CEO, Escorts Agri Machinery, Mr. Sunil Saxena, CEO, Escorts Construction Equipment, Mr. Dipankar Ghosh, CEO, Escorts Auto and Railway Products, Mr. Bharat Madan, Group Financial Controller, Ms. Jyoti Khaduka, Head Treasury, Mr. Saikad Mukhopadhyay, CFO, Escorts Construction Equipment, and the Investor Relations team at Escorts Limited. We will start the call with a brief opening remarks from the management, followed by an interactive Q&A session. Before we start, I would like to add that some of the statements that we make in today's discussion will be forward-looking in nature. At this moment, I would request Mr. Madan to make his opening remarks. Thank you, and over to you.
Thank you, Ravindra. Ladies and gentlemen, a very good morning to you all. Thank you for joining us on the second quarter earnings call for financial year 2015. A snapshot of company's quarterly performance is as follows. Turnover for the quarter increased by 5.1% on YOY basis to Rs 992.6 crores. This is primarily due to increase in volumes both tractor and construction equipment as compared to last year. Tractor volumes at 15,013 correspondingly up by 1.2% as against 14,842 last year. Construction volume at 747 numbers correspondingly up by 13% as against 661 last year. The EBITDA has dropped to Rs 33.5 crores as against Rs 64.5 crores last year. The major reasons for the fall in profitability are lower production volume leading to under absorption of production overheads as compared to last year in agri machinery, and poor product mix in construction equipment resulting in increase in material cost by 205 basis points. However, sequentially it has improved by about 100 basis points. Increase in other expenses due to increased promotional spends, consulting charges and expenses pertaining to export orders for tractors. Increase in employee costs marginally as a result of long-term settlement with trade unions. However, the cost is down sequentially as compared to Q1 2015. Exceptional expenses are Rs 31 crores for VRS. We continue to bring down our finance cost, which is lower by 23% compared to last year at Rs 14 crores. Our total debt outstanding as of September 2014 is 505 crores. Now moving on to segmental business performance. Now starting with the agri machinery business. Domestic tractor industry is flat at 1,41,483 tractors as compared to 1,41,241 tractors last year. This is due to the subnormal rainfall in the northern and central region. Our domestic tractor volumes were down by 3.3% as compared to last year, and export volumes were up by 270%. In line with our strategy to become market leader in higher HP segments, our tractor volumes in 50 plus HP grew by 218% as compared to last year. Our market share in this segment also grew from 3.46% to 8.64% in Q2. This segment also grew by 27.6% and therefore its share in the total industry has increased to 5.1% against 4% last year. EBIT margins in EM has gone down from 10.9% to 7.1%. We are expecting to better our margins in second half with the help of new product launches and reduce material costs through our initiatives. In the next 3 to 6 months, we shall also be recovering full price for our new products which are established well in the market. Coming to the construction equipment business, the served industry volume is down by 9.5% to 6,400 units against 7,100 units last year. Whereas our volumes are up by 13% to 747 numbers against 661. Our revenue increased by 4.6% to Rs 121.5 crores. The increase in our market share is a result of growing product acceptability in the market. We will continue to develop and offer innovative products and move up the value chain. Our EBIT losses, however, went up to 10.8 crores from 4.8 crores as compared to last year. We are now focusing on improving sales mix, improve spare sales and increase our realizations to move to profitability in this business. As mentioned earlier, we have taken a number of initiatives in the area of material cost reduction and product standardization. We are making a good progress in these areas. With the result of these projects, coupled with better sales mix and realizations, we are confident of achieving positive EBITDA by Q4FY15. Coming to the railway division, the order flow from railway continues to remain subdued. At Escorts, we are developing product for new generation rolling stocks as we are seeing a decline for the old generation rolling stocks. We are also evaluating new technological tie-ups to widen our product portfolio. Sales up by 10.8% sequentially and down correspondingly by 6.29% to 47.35 crores. The margins up by 580 basis points sequentially and 105 basis points correspondingly to 9.6%. Our order book for this division stood at Rs 34 crore, which will get executed in the next 3 to 4 months. The railway division stands to gain from the renewed focus of the government on reviving the rail infrastructure in India. We expect to complete testing and win new orders for our new product bogie-mounted braking systems in the coming quarter. Lastly, on the auto division, it reported a revenue of 26.8 crores, up by 17% sequentially. The EBIT loss for the quarter reduced to Rs 6.99 crores from Rs 9.21 crores in Q1 2015. This is due to the increased sales and reduced manpower costs. The full impact of reduced costs shall be visible in the next quarter, and losses are further expected to go down in the next quarter. As disclosed earlier, with a focus to increase profitability and productivity, we have successfully implemented company-wide VRS aimed particularly at restructuring our Escorts Auto Product Division. This largest ever VRS at Escorts was availed by around 350 employees. We incurred a one-time expense of approximately Rs 31 crores. The payback for this will be less than 2 years. With all these initiatives, the management expects improvement in margins in H2 of this financial year 2015. Now I request the moderator to open the floor for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sameer Deshpande from Fairdeal Investments. Please go ahead.
Hello.
Yes, Sameer.
Good morning.
Good morning.
See, actually, the results were a bit disappointing this time because we saw the margins crash to almost 3.3%, which is sequentially also down about 1.7%, almost half of the last year. The tractor industry is not doing well, that everyone knows, but still the segment margins have also come down substantially to almost 7% for our agricultural business. And see, the volumes we could just maintain this time because the rains were also a bit erratic, all those things. But the construction equipment, we mentioned that our growth in volumes is about 15% or odd. And the outlook is likely to be better. But we are still losing almost 11 crores. And if the turnover is growing and our loss is increasing, how can we say that there is an improvement in the construction equipment business?
Good morning. This is Sunil Saxena from Construction Equipment Business.
Yes.
Your question is absolutely apt. In fact, Bharat did mention about some of the areas where we are now concentrating, which is related largely to the sales mix, where we need to sell more of value-added products, which is what we have started with our renewed Digmax 2, which is now virtually becoming a segment acceptance in leadership position. It is one of the best backhoes that we have. It's coming around, and that really adds value both in terms of top line and a better bottom line. So we, as a construction equipment division, our topmost priority is to ensure that the sales mix is in that direction. That obviously took some time in terms of the industry where it was, where the industry itself in the quarter 2 was not coming off well. Now that it is increasing, our sales mix is really going to yield results. Spares was also one of the areas where we had to really connect with the customers, which is one area where we have strongly come back. and you will see those things really resulting into better both top line and bottom line as we go into Q3 and more importantly in Q4 actually.
Achha, but when are we expected to operationally break even in that EBITDA level in ECL?
We will, in terms of the EBITDA, we'll certainly see a positive level by the end of Q3. In fact, we have started realizing better margins for our product, and you'll see that happening around the Q3 in terms of realization. But EBITDA positive will certainly start off as we start off the Q4.
So Q3 you expect to break even and you may be positive in Q4?
Yes. Q4 is what we expect to be.
So now, now our pick and carry crane business, etc., which was the main bread and butter business, is it continuously losing money only?
See, as I said, we have to shift gears in terms of value-added products and also the mix. When we mean that, we have to really have a high-ticket item in terms of the product range that we have, which comes in from the backhoe industry, which is also the major industry in construction equipment industry. So we are concentrating heavily, not that the pick and carry crane is something which is not giving us margins. We need to sustain that, but more importantly, increase the proportion of backhoe sales, which has got a better realization and also a larger volume in the industry. And since we are in this industry relatively new out of the 10 players, to establish ourselves to a leadership position will really take some time. In fact, the good part is in Q2, we were the only player out of the 10 players who were improving in the backhoe industry compared to all others existing. So you will see that result spinning off in Q3 and Q4.
You are experiencing some positive trends in construction equipment?
There's a lot of talk, but if I were to say, has it happened on the ground completely? Not so, because the industry still is it's not in a growth mode. It's still showing decline. Thankfully, we have got good customer base right now, and as ECE in Escorts, we are showing better than the industry in terms of the growth results.
Okay, all the best to you. And now my earlier question, can this agriculture related?
Yeah, Samit, if you recall, I just answered this in the opening remarks. The three reasons which are essentially there for agri business, the EBIT going down. If you look at from sequential quarter from June we were at about 8.1% EBIT margin, and this quarter we are at 7.1%. Right. One of the prime reasons for there is the increase in the other expenses. Now, we had executed a large export order in this quarter. There's an order for Nigeria which was executed. So there's a one-time expense which has happened in this quarter. So the other cost, if you look at, that has gone up significantly in this quarter to about 14%. Now, that's one of the reasons where the EBIT margin for agri has come down. Otherwise, on all cost initiatives, whether it is on manpower cost or on the material cost front, you see an improvement from the last sequential quarter. Right. So in terms of margin expansion, we are confident in agri. You will see in the next going forward in Q3 and Q4, the margins coming back to the normal level. And this normally is the leanest quarter in the entire year. So that's one of the reasons also, because the lowest volumes are there in this quarter, so you see an impact on the EBIT margin.
Achha, but this one-time expenditure relating to Nigeria, which you mentioned one time, can you quantify that?
This will be to the tune of 11 to 12 crores in this quarter.
Relating to this Nigerian export order solely. Right. So that will not appear. So you expect the segment margins to be 8% plus next time?
Yeah, it will be.
And we have not increased the prices last time?
We have taken the price increase from 1st of August. So we done about 1% price increase on the tractor.
Achha. Despite that, did we add this setback? Now we are not planning to increase it now, no?
It depends on the market. So probably we will take a call in Q4, but not in Q3 definitely.
Okay.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. Thank you. The next question is from the line of Yashish Mukhi from Morgan Stanley. Please go ahead.
Hi, good morning, sir. Sir, my question was pertaining to the agri business. Just want to get a sense of, how demand is at the retail level, and, what do you expect going forward for the rest of the year?
Okay. Good morning, Ashish. See, it's about industry. So first, let me answer about the industry itself. So far, in the last 2 quarters, the industry is reported as flat. Actually, this is not the case. If you recall our couple of our own interactions before the Q1 and Q2 itself, we talked about something like a 5% negative in the quarter 1. some 2 or 3% negative in this second quarter, expected to be little positive in third quarter, and substantially. This is the way we have anticipated. At secondary level, it has almost happened that way. Whereas the releases was not supporting what was happening in the market. The net result is it has become flat, even though it was negative so far. On the contrary, whatever you are seeing now on the releases, or means the wholesales, the billing side of it will see a huge negative, almost like a 12% drop in October. Going forward in this quarter, it may report something like 8 to 10% of industry negative. But the truth is, this is not this severe, the way it will get reported now. Maybe the stocks are getting adjusted. So if you look at it, overall picture is not really bad. It happens in the way we actually expected. But end of the year, we did expect something like a 2 or 3% positive. It may remain as at 2 or 3% negative. A swing of 2 to 3%. Hello. So 2 to 3% positive to negative is what is emerged over a period of 6 months.
Right. So for the full year, you will see about a 2 to 3% year-on-year growth.
That's right.
Okay. And sir, what will drive the sharp growth in the second half?
It will not grow. Actually, see what happened is one is a low base effect. If you look at the data a little more closely, the quarter one of last year has grown something like somewhere around 26 to 30% growth. With that kind of a growth rate, I personally was looking for a 5% negative. It came as zero growth. Okay, so otherwise it's not a surprise. And same is the reason of almost like year before last year, something like a 20% growth. And now onwards, it will get moderating at 15% and something like 6 to 8%. So the base effect itself is becoming, it's getting moderated. Second is, we did expected the quarter 4 to be very positive, but which I think now we are moderating it a little bit because the sheer quantity of rainfall was also not adequate. So the groundwater availability, all other parameters are also not becoming that kind of a positive. So the net effect is, we are not saying that quarter 3 and quarter 4 is going to become bullish, but it will not be the kind of a negative outlook we will develop based on the billing is not the case. That is exactly what I am trying to put it across.
Right. Sir, and one more question, sir. What proportion of tractors currently sold would be for non-agri use? Can you give us a sense of that?
See, it's very difficult. See, every tractor is being used for both the purpose. It's only the extent that really matters. There are some products are dominant that kind of a sector. Some products are not so dominant in that kind of a sector. Okay, generally, if I am to give you one insight, our brands, both the Power Track and Farm Track kind of a brands are not very effective in that kind of a sector. So you will see us launching one of the new products. What Bharat has spoken about is getting launched in a couple of months, specifically targeting that sector.
Okay. And sir, any proportion, would you say it's about 30-40% less, more?
I'm sorry?
Would you say the non-agri proportion would be about 30% or so? Is that a fair comment?
See, what happens is for some of the brands, this is really predominant. Some brand it is not so. But you can guesstimate around 50 to 55% on the on the haulage market. But where haulage happens, it happens intensely. But otherwise, it varies between place to place.
Right. Okay, great, sir. Thanks a lot and good luck.
Thank you. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Murugesh R.S. from Cholamandalam Securities. Please go ahead.
Good morning, sir. I just joined the call a little late, so if you can give me the tractor numbers and construction equipment numbers, that would be great.
You seeing volumes?
Yeah, volumes.
Okay, on the tractor we did 15,013 numbers total, out of which 896 for export. And on construction equipment we did 747 numbers.
747?
That's right.
Okay. My next question is, we have been talking about in the previous Concall also, we were mentioning that the 45 to 50 HP tractors, which was a pressure point for Escorts in particular because of the lack of presence in markets like Andhra where it was growing continuously. Could you throw some light on where the industry is now, how the industry has been in the last 2 quarters and how we have fared in the last 2 quarters? Have we added more dealers, or if we were trying to extend our presence and reach, how successful are we in that endeavor?
See, I think what you are asking for is more to do with our own strategy direction, which does not change over a period of time.
Okay.
So when it comes to segment growth, we already have said almost 12% of the segment which represent the bottom of the tractor industry, we do not participate. So that is why we do not go at overall market share calculations, because some of these segments we stay away, where we do not see a profit potential. What is growing is the bottommost segment and the topmost segment. The horsepowers below 20 horsepower, the horsepowers above 50 are the two segments which is growing the fastest. The bottommost segment we do not participate. So we stay away from that. Whereas in the segment which is there in the highermost is a segment where we were betting on a very good position, on a leadership position eventually. Targeting something like 18 to 20% market share in a 3-year time frame. This is what we disclosed 1 year back. So in that segment, from almost 0 to 1% share, we are almost at 8.5% share in the last quarter. And ours is the fastest growing brand in that segment with a growth rate of something like 225 or 230%. 18% kind of a growth rate happening there. So we are very clear on our path. Another important segment where a lot of profits are there are the 45 to 50 horsepower segment. This is where a lot of launches are scheduled, things are happening. We have products like executive products, what we call 60, 50, 60, 45 are doing very well. These are all the products, even though the quantities are small, these are all the few brands which went out of stock, if I have to tell you the list. So these things are received very well in the market. But if I am to give you another side of the picture, like Hero is another series what we launched. Maybe I think we launched around November of last year. So from almost 0, it has 40% of our power track sale is through Hero brand, which is little more expensive. It has got a lot of new generation features, and this is also the reason we quoted that we have a difficulty in absorbing the entire material cost. We said a 4-quarter time frame we required to absorb that kind of a money. Now let me tell you that we are almost there. With August price increase, we almost recovered 80 to 90%. So some more things are left, but otherwise we are there. So if I am to give you a summary of what we have said is, with reference to our own strategic intent, we are already there. So on the segment of our choice, we are progressing. So maybe it is 2 more quarters we have to wait and see a substantial progress in those kind of a market share on the chosen segment.
Okay. So just to follow up, so would it be possible for you to give me a target? I understand that 50 HP is our main focus, having vacated the 20 HP segment. But in case of 45 to 50 HP segment, do you have a target as far as the market share is concerned, or the number of tractors you would want to sell in the next few quarters?
See, this kind of a segment is not tracked by any external body, including TMA. So it's very highly internalized, so you will not even get to know. But even to give you an idea, from a level of something like 16 to 17%, we would like to eventually take it to 22 to 23% in another 2 to 3 year time frame. So the most important segment for us is, in addition to the above 50 horsepower segment, this 45 to 50 horsepower segment also remains a very important segment. Today we are hovering around 16 to 17% market share in those kind of segments.
Okay, going back to my original question, would it be possible for you to give a sense as to have you added more dealers in Andhra regions or Karnataka regions, which was a pressure point for us?
See, this is we have already mentioned, we do not look at the channel as the basis of a differentiation. We look at it, our own brand and product strategies as a basis of differentiation, and then we support through a dealer network. So whichever place we are already doing well. For example, we have some 12 dealers in Andhra who already are reporting anywhere around 15 to 20% market share as against the overall market share of 4%. So as and when our product strategies are working in the chosen market, this will be the proportionate number of dealers will get increased. So there is a wave of action put in place, but this all will take almost 3 years. We are almost 1 year is what we have passed. 2 more years are to go.
Okay. Can I squeeze in one more question regarding VRS?
Yeah, please go ahead.
Yeah, I understand that we have been giving VRS segments to, especially for the auto segment, to bring down the legacy employee cost that we have. I just wanted to understand, where do we stand right now, and when do you expect to finish this?
Well, we already implemented the VRS scheme. So this quarter, you already seen the exceptional item of 31 crores coming on out of that. So about 350 employees, workers have taken the VRS in the last quarter in Q2. So you'll see the benefit coming in from Q3 onwards.
Q3 onwards. Yeah. Would it be possible to quantify how much benefit would be in terms of margins?
The payback for this spend was close to 1.5 to 2 years. So I think most of it will get recovered in next 2 years time frame.
Okay. That's about it. Thank you.
Thank you.
Thank you. The next question is from the line of Viraj Kacharia from Securities Investment Management. Please go ahead.
Yeah, thank you for the opportunity. Most of my questions were answered. Just two more. We launched a steel track, which is a sub-20 HP tractor in October 2013. Can you just give some color on how's the response been so far and what stage we launched the model in?
Yeah, this steel track is we have been speaking about less than 20 horsepower. We call this kind of segments as not strategic. Means neither it enhances our top line or the bottom line. So what we do is we take the route of outsourcing. So these products are completely outsourced to one of our own major suppliers who are very competent, who have a cost structure to support those kind of a product which are potentially a low margin, eventually can be a high volume kind of a product. So these things are almost done. I think we started selling something like 30, 40 kind of tractors. So it's being done. It will further volumes will gear up. We do not count on for those kind of financial discussions actually. So it's on.
Okay, so as we continue to focus on the above 45 HP as a segment focus, we're not looking any product expansion in the sub-20, sub-25 HP segment because we have primarily vacated from that segment primarily because to focus on the high HP. So as a strategic focus, are we looking at expanding the products range in that segment through outsourcing, or we're not even looking at option?
Okay, I think so. When we said this is not strategic, what we mean is Escorts Limited per se will not spend their own time, money, resources into those kind of activities. But having said that, there is a demand for those kind of products. There are channel partners who want their portfolio to be complete. So there are customers who are wanting to buy. So how do we answer this? The route what we take is through outsourcing.
Right.
Okay. So even though we are not, so in other words, even though it is not a matter of our interest directly, eventually those kind of demand will be met through an outsourcing partner. So less than 20 horsepower is already, we have one product line. There are some programs which is going on, which is profitable for that form and may not be for companies like Escorts. So those kind of things will get addressed to first stage. Eventually we will address the 20 to 30 horsepower as well. But having said that, that is not our focus. Neither we want to discuss on those kind of areas today. So maybe 2 years from now, you will understand some of our product plans, which will make even those categories as very attractive. But as of now, we do consider that this is not worthwhile concentrating on those segments.
Okay, so are these also sold through a current dealer network, or they actually, so on a branding perspective, it goes through the Escort network?
See, these things will be sold only through existing network, because if you create a network, it also costs money. Every channel increases an obligation. So it involves money. So we cannot create this kind of a product which lives on a very, very marginal costing, has to live on the existing kind of a network. So it will be sold through our own network.
Okay. And any update on this other small farm agri machinery which we're looking to venture into?
I'm sorry?
Any update on the other agri small farm machinery segments which we're looking to venture into?
See, the business models are being developed. As we said that as and when we become thorough, we will start sharing it with you. I think now also I feel we are not yet comfortable in terms of public disclosure. So kindly give us 2 more quarters. Then we will share it in full.
Okay, that's all from my side. Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Kamlesh Kotak from AMSEC. Please go ahead.
Hello, good morning, sir. Hello.
Yeah, good morning.
My question is pertaining to the construction machinery business. You said units for this quarter 747, right?
Yeah, 747.
How much was the half year and the year-on-year numbers?
Half year was 1,466. Okay. Last year half year was 1,379, and the quarter last year was 661.
Okay. Can you further break it up into the backhoe and the pick and carry cranes, or the major segments of that?
Yeah, largely on the backhoes, we have been now getting to a volume of about 75 a month. We have to increase our volumes there. That's where when Bharat made his opening remark in terms of the sales mix. In fact, we're really happy to state that we're the only ones in the first half of this year, where we were showing growth vis-a-vis the previous year same time, out of the 10 players.
Okay. And what is about the pick and carry crane volumes, or how that has panned out?
Pick and carry cranes, we had a volume of about for the first quarter we had a volume of 478, and the second quarter was 488.
And how much was that last year, sir?
Vis-a-vis last year on the cranes, we have been growing at about 10%.
Okay. And how the competitive intensity in terms of the pricing and how the overall industry is panning out, sir?
Yeah. The industry is really going through a very torrid time for last almost 30 months. There has been a consistent decline if you were to look at month on month, or you were to look at the same period last year. Elevate last about 3 or 4 months, the extent of decline has been steadily coming down. What we expect is the industry will cross the horizon, that is zero, sometime around end of Q3. In fact, as we end September also, the industry was still down by about 15%. What we expect is with all the announcements, particularly in the mining, in the coal sectors and other material handling equipment areas, the industry will start showing a positive result by the end of Q3. That's where we really will see benefits of whatever we have done in the past, let's say, about 6 months in the division.
And so going forward, sir, how you see the growth across these two main verticals, the backhoe and this crane? How you see the volume or the value growth panning out over the next year, maybe?
Yeah. In terms of the industry as such, we anticipate a CAGR of around 10 to 12% over next 2 years on the backhoe industry as such. We have been relatively new players in the industry, having launched our first backhoe in 2010, and we've launched the version which the customers wanted with a lot of USPs, I would say, lot of positives that the customers fed us back, which was about just less than a year back. With that, our product is finding a favor, and we expect to beat the growth rates of the industry. And backhoe is one area where the ticket size and the value would be larger, and that's how we've been continuously saying that our sales mix and therefore our profitability should improve once we show good growth on backhoe. Having said that, in the first 6 months itself, vis-a-vis the industry, we have been growing on backhoe. So the acceptability of our product in the market, which has almost 10 players and some of them entrenched for over last 15, 20 and even 30 years, has been extremely good and very encouraging from the customer perspective.
So should we assume a 12-15% kind of growth vis-a-vis 10% growth for the industry?
Yes. In fact, if you see the current performance itself, on the backhoes, we have been growing at that rate, and we will be continuing to be putting pressure on our entire, I should say, channel partners as well as our own team to ensure that we really come out flying colors, particularly in the backhoe area.
And on the crane side, what could be our growth trajectory, sir, vis-a-vis the industry for the next year?
Yeah, the industry itself is marginally growing. It's just about 3-odd% kind of growth that has happened. We have been again growing better than the industry there. Now, it's an industry where the value addition is low and the ticket size is also very small. So large growths in cranes aren't going to change too much for us, except for the fact that the capacity utilization would be there. So we will be sustaining our game plans on material handling, but more importantly within that, like we do on tractors, we'll be concentrating on the higher value add products on the cranes, where we have continuously as Escorts tried to improve on the value chains, which means the Hydra would be something which will be sustaining the volumes, but we'll be moving up in terms of the carrying capacities like power booms and TRXs and Frana type of cranes, which have more value addition, and therefore they augur well for the industry standards also and the growth also.
So maybe next year we can expect double-digit growth in that segment as well?
I think double-digit growth will still take some time, because what will happen is the larger volume is in the 12 ton, which is the Hydra equivalent volumes. The volume over that is pretty small, and it's exactly like tractors where the value add or the higher tonnage products formulate a lesser volume out of the total. So unless you see a overall growth in the industry itself of about 15%. You wouldn't see a significant play in the higher tonnage. What it will do is, if we concentrate on the mix, it will give us a better profitability.
Sure. And so lastly, can you help us understand the debt profile? Is there any debt reduction plan? Because this quarter, I think the debt has gone up compared to the March amount. So how you see that paying out for the year?
Yeah, this time since the quarter was slow, so the cash flow was slightly negative on the operation side because it's typically a lean quarter. But the next quarter, this will again get made up. So if you look at overall debt profile, we are exiting the September at 505 crores, out of which the term debt was about 235 crores and balance the working capital. So working capital collection would happen in the months going forward. So like October was a good month for cash wise. But overall, like I said in the past, the average debt will continue to be in the 400 to 450 crores range. Though the term debt repayment is happening every year, about 80 odd crores is getting repaid. So I think it's another 3.5 years. If there's no major borrowing further, then it will get reduced to probably in 3 years time it will get liquidated.
Sure. And any idea on the capex side for this year and the next year?
Capex this year we are looking at a capex of course to 80 to 90 crores, and I think the similar number will continue going forward also, at least in the next 2 years.
That will for farm equipments or for which segments?
Major on the farm equipment, but overall, this is the overall number I'm saying.
Okay. Great, sir. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 if you would like to ask a question. The next question is from the line of Saket Kapoor from S Financial. Please go ahead.
Yeah, good morning, everybody.
Morning, Sachin.
Yes, sir. My query is regarding the railway product segment. Sir, we see the EBITDA margin being 580 basis point up sequentially. So there was any particular product mix that created this increase in margin? Is it sustainable over the next 2 quarters? And what should be expected on an annualized basis on the railway equipment part itself?
The EBITDA is sustainable. And moreover, the fact that, though there has been little bit of a subdued outlook from the market because some major orders, though it's supposed to be released, we have LOIs, it is not released. So we expect those things to be released by Q3. So we see Q3 and Q4, the EBITDA margin, we will be able to sustain the EBITDA margins. And some of the new products, what we talk about, like bogie-mounted brake systems and some of the other rubber to metal bonded products which we have recently launched, should be taking us to a better EBITDA margin maybe in Q4 and the next year.
So that means it will be a double digit. Right now we have clocked a margin of 9.6%. So are we heading towards 10 plus margins going forward?
Well, this year I think it will remain in this range only. It will be somewhere 9 to 10% range. But yes, slowly going forward, we can look at it, the order really book expands, and you start getting the order released from the government, and we'll see a margin improvement happening there.
You were telling that there is order in the pipeline. So what should be the ballpark money? Just now the order booking is around only 34 crore as on 1st October as stated by...
Actually, the order booking is more, but the problem is that there is a huge decision paralysis, I would say, in the government. Though the order booking shows 34, we have a lot of LOIs, letter of intents, which has to be finally converted to orders. That we are expecting in Q3 and Q4 to come. And it will be, I don't want to give a forward-looking number, but it will be in the range of almost 60 to 70 crores.
Additional 60 to 70 crores in addition to this 34 crores.
Yeah, but again, until unless they are converted, because railway is still going through a huge fund crisis, and obviously decisions are not being taken, and parallelly there's a big news in the market of railway board restructuring. So until unless these things fall in place, we will not be able to really have a major change in the top line and also the EBITDA levels.
So this 34 crore order book is executable over what period, sir?
This 34 crore order book is executable in Q3.
The Q3 will itself getting.
Yeah.
So the Q3 will be there will be a huge bump up because generally we are clocking a turnover around 45 to 50 crore. So it should be up exponentially in the region of 80 crore if the sequence is like...
No. You got it wrong.
It will remain in this range only.
Yeah.
Sachin.
Okay, sir. It is only on the construction equipment part that although that the turnover has been improved, you have already also explained, but we are missing in the, I think, the product mix that losses are being posted on higher turnover. So how soon will this position will be corrected, and what should we be expecting it on an annualized basis going forward in the 2 quarters?
In the 2 quarters, our attempt is to first ensure that on the EBITDA end we turn positive by the end of Q3, which means coming to Q4 we should certainly be positive, and that will be by virtue of a better product mix as well as the demand which is now expected to shed negative trends.
Okay. Yeah. Thank you, sir. That's all from my side. Thank you.
Thank you. The next question is from the line of Karthik Subramanian from HSBC. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Just on the agri machinery business, I think I just missed the number. So could you just repeat the industry growth you foresee for FY15? Is it 2 to 3% growth?
Yeah. See,
right.
Growth. See, what we talked about is this is what we have originally we were looking for. It can come down to -2 to -3% as well.
Oh, okay. And just a quick one, if I may, could you just throw some light on the current trends in discounting in the tractor business you're seeing in the industry in general?
This is high only. See, they should have heard it from the other manufacturers in their own investor calls. So when the industry is going for a negative, you will see discounting, incentives, all other things moving up. Currently, it's very high.
Thanks, sir. Thank you.
Thank you. The next question is from the line of Indranil Das from 8 Capital. Please go ahead.
Good morning, sir. Thank you for allowing me to ask a question. I have a small question. If you can share your current capacity utilization number for these agri machinery products and auto ancillary products.
Yeah, it's already there.
Last page. For construction, it's at about 41% last quarter, and for auto product it was at 44%.
Tractors at 30%.
And tractor is close to 70%, and railway is 93%.
Hello. Thank you, sir. Thank you. I have no further question.
Okay, thank you.
Thank you. The next question is from the line of Yashesh Mukhi from Morgan Stanley. Please go ahead.
Just a follow-up question, sir. Sir, you mentioned that discounting levels are quite high across the industry. Could you give us a sense of, what those numbers could be in terms of percentage of selling price?
Something like 15,000 on a product of something like a 5 lakh. It's an average. This is advertised. Whatever I'm talking about is what is there in public domain. So what goes below dealerships or incentives, we have no formal access. So 15,000 is a kind of a price drops are seen through paper advertisements.
Right. Sir, also just another general question, sticking to the agri industry. Sir, I want to understand, you mentioned monsoons earlier, but what are the other main drivers of tractor growth, for the industry apart from the monsoon? Is it highly linked to that, or are there other factors that could influence demand?
Okay. See, one is the monsoon, but the most important output, two things what is important in agri field is the crop output and the price. So if inflation is depressed, which may be good for the common man, generally not a good idea for tractor industry actually. So the farmers really don't make money unless there is some food inflation. So, and this year what happened thanks to this erratic monsoon, the crop area which is just 2% is on the surface. If you actually look at it, the kind of a crop what farmers have opted for are less remunerative and drought resistant kind of a varieties which does not get them a good price. So if they don't get a good price, it's a problem. So the prevailing price and is a very important indicator, and the inflation, these things really supports. So both are, that is why sentiment is down overall. Some packets, if you go places like Maharashtra where I have personally visited, I think farmer sentiments were really negative, not very happy.
Right. So on the non-agri front, you mentioned that this is almost half of the tractor demand, and that is, I believe, growing. What are the key drivers there?
It was not growing. See, what happened was, what you see on the surface is a flat demand. What was happening was a negative. It was almost a 5% in the first quarter and 2 to 3% on the second quarter. This was not noticed because billing was happening on a particular rate, and those things get corrected now. What I said was suddenly from a 12% drop in the month of October, which will mean something like 8 or 10% negative growth in quarter 3, will look depressing. The real situation is not that way. Right. Still, it can be minus 3% types, 3%, 4% type, but cannot be 8 to 10% the way it will get reported subsequently. Only this I was explaining.
Sir, my question was pertaining to the non-agri part of the demand. So what drives that primarily?
See, the haulage market is generally the prosperity, general economic activity. The haulage activity is not about agriculture. It is about overall construction, road making, every activity what is there in the rural urban area. So it's more to do with the economic well-being actually. And that evidences are also not very good. That we have already said that has an indirect effect on tractors, because with that the buying back, the second-hand tractors what the dealers buy, which is over 50% of the tractors dealers buy back, the pull for those kind of product category gets established, making it easier for them to sell new products. Even that is choking. That means that part of the economy is also not doing well.
Right. Okay, great. Thanks a lot, sir.
Thank you. The next question is from the line of Kishan Gupta from CD Research. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
Yeah, how much would you think restructuring of auto products business help in curtailing losses?
If you see, we have in this 350 people who have moved out from the Escorts group as a whole. A total of almost 200 people would be moving out from auto business itself. So it will be month-on-month basis more than 1 crore sort of a thing. And parallelly, there are a few other cost initiatives which we have undertaken within the division. So that itself, we feel that, or we are confident that by March 2015, we should be back in black.
March 2015, you are saying, right? But as you said that the quarterly saving will be somewhere in the range of 1 crore or thereabouts. And if we see the EBIT loss was around 7 crores last quarter, so how will it work out?
The quarter saving on account of VRS will be close to 3.5 crores in a quarter. So it's 1 crore a month, he's saying. So 1 crore plus in a month.
Okay, 3 crores.
3.5 crores each quarter they will save on account of VRS, which has been already introduced and implemented. Yeah. And over and above that, any volume growth which happens on the product expansion, improvement in product mix, that will probably lead to the break-even levels. Q4.
Any other VRS expense expected in coming quarters?
Not in this year. And
okay.
We'll review the situation next year depending on how the cash flows are at that time.
And how would you explain almost 100 crores dip in non-current assets in the first half?
There's a reclassification of an item. The bank balance is lying there. It's an escrow account. It's been reclassified from non-current to current. So you see the increase happening on the current asset side and decrease happening on the non-current side. So overall balance sheet size is the same.
Okay. And last question, why hasn't the construction equipment business shown traction despite double-digit growth in volumes?
Yeah, on the construction industry, if you really see, the industry per se is really into a decline mode continuously. And if you classify the construction industry as such, in fact, it is earth moving and construction. What really is happening is the low value add which happens on the material handling. That's where numbers are sustaining, but on the actual high ticket items where earth moving takes place, which is largely related, let's say, work for sand, coal, mining, and real construction sites where roads are built, all those are the activities which have really not taken off. So in terms of the volume growth, unless the markets for products like backhoe and compactors both show increase, only the material handling equipment increase wouldn't bring in the kind of both top line and bottom line that we expect.
So it's only on revival of the overall economy which will turn the business, you're saying?
No, there are two things. Within our mix, we need to really look at the value-added products within the material handling itself, which means the higher tonnage cranes and cranes which have power booms and cranes like Frana, where we are market leaders. So essentially concentrate more on the value-added and high tonnage products. At the same time, ensure that in the backhoe market, despite of a decline, we ensure that our volumes increase and our product finds acceptability, which is what is happening. The constraint with which we are working in the backhoe area is we are the latest entrant out of the 10 players, and our product is just about getting established after the Digmax 2 was launched about a year back. So we have very positive reviews, and by the time the volume gains happen, and I just would like to say that despite of the decline in the market on backhoes, the volumes of backhoes, even at a small base for Escorts, have been increasing. So once they reach a threshold minimum of about 150, that's the time you will really see things happening for the construction equipment group. And we expect by, as I've been saying, after we'll exit possibly the Q3 to start off EBITDA positive, and we should see by that time things getting better for the industry as such.
Thank you so much. Yeah.
Thank you. We'll take our last question, which is a follow-up from the line of Sameer Deshpande from Fair Deal Investments. Please go ahead.
Hello.
Yes, Sameer.
Thank you for giving me another chance. So actually, I wanted to know about tractors. We are exporting to Europe, and we really had some better volumes in this quarter or even the previous one. So I wanted to know our policy of export credit. Because earlier, I remember a few years back, we had very large problems with our exports because of the recovery were very high, and we had to write them off as bad debts. So because our US exports and I think Africa also had a very bad experience. So now what is the trend in our exports? That is, are we making better margins there? And what are the credit period and what are the precautions we are taking to prevent bad debts?
The exports to countries or to the companies which are other than our own subsidiary, they all bear based on LCs. And typical trade period there ranges from at site to 90 days.
Acha. 90 days.
Yeah. And they all LC backed, so they are really secured. And we are taking extra precautions, so wherever it's unsecured, we go for an ECGC cover. There is an insurance cover which is also there.
So there is no risk for bad debts as such in these things?
Not for the third companies.
And Europe, I think, is again facing a slowdown. So I am asking this question because we are targeting Europe only.
No, in Europe, it's our own subsidiary, so our export to our subsidiaries are very low as of now. And earlier, it used to be a big number because we were supplying fully built tractors from India. But now we are only catering to the SKD, which is about 20-25% of the component which they assemble there. So balance is procured locally from there. So in terms of our exposures, they are low compared to the total outstanding in exports. So it's not very high. And that's the risk which you can't cover through ECGC because the beneficiary and risk, the insurers are the same.
Acha. So, okay. And the trend in export continues to be good?
Yes. Yeah, it continues to be good. So we'll see the good numbers coming in going forward on the export front from our side. And the margins on the export, there's another question you asked, is comparable to the domestic margins.
Okay, they are similar to the...
Yeah, as long as the rupee doesn't appreciate to an alarming level, at this level we are very comfortable.
So the margins continue to be okay on this.
That's right.
And about this VRS, it was mentioned that payback period is 2 years.
That's right.
So are we expected to save around 4 crores on our employee cost every year, every quarter, if I go by that way, 8 quarters?
Yeah, it will be around that. It will be more than that slightly.
4 to 5 crores on that front.
Yeah.
And okay then, all the best.
Okay, thank you, Samit.
Thank you. As there are no further questions, I would now like to hand the floor over to the management for closing comments.
Okay, thank you, gentlemen, for being present on this call. Also, I would like to mention that we distribute our earnings release through our website, www.escortsgroup.com. So do refer to our website for our earning releases as well as other details, and this transcript will be available on our website after some time. Also, you can visit our social media pages for the latest company news, development, etc. We'll meet again at the end of our Q3 results. Thank you very much and have a good day.
Thank you. On behalf of Escorts Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.